Welcome to week 3 of financial statement analysis. This week we're going to be doing common size and trend analyses. The math and the calculations that we're going to be using are really straightforward. So the focus is not just on memorizing calculations, although we're going to need to do that, but on using the information to be able to tell a story about how a company's performance and how its financial position has changed over time, or how it compares to prior periods for that one particular company. Let's start our analyses now. The PowerPoint file in Blackboard where we're going to take our notes. And let's start with the common size analysis. The common size analysis is also called a vertical analysis because we are calculating everything down in a row within that same year for a company. The common size analysis allows us to compare the performance and financial position of different size companies or of one company over time. In a common size income statement, each item is expressed as a percentage of sales. Because sales is what's driving just about everything else on that income statement. Cost of goods sold, of course. Selling general administrative expenses are highly correlated with sales, hopefully in producing sales. Now, non-operating income items such as interest expense and other income and revenues, other gains and losses are much less highly correlated with sales, but still it's interesting to see that. And it's also interesting to see the subtotals: gross margin, income before taxes, operating income, net income as a percentage of sales. A common size balance sheet expresses each item as a percentage of total assets. And so we're going to calculate each asset on the balance sheet as a percentage of total assets, of course. And we can look at each liability as a percentage of total assets, but really, because that's a little bit easier to do for the math-wise, but really what we're saying is each liability as a percentage of total liabilities plus stockholders' equity. But we know that stockholders' equity plus total liabilities is equal to assets. But really want to say how much of that one liability account as a percentage of total financing. And then finally, each equity account. We can calculate that easily as a percentage of total assets, but really what we're thinking about is how much is each equity account as a percentage of total financing. Our common size analysis can be done of one company over 2 or more periods. And so one common size income statement or balance sheet alone is really not terribly informative. We really want to see it in comparison to another period or another company. We're going to start our own analysis over two or three periods, and then we're also going to compare one company at one point in time to several other companies. Looking at one company over 2 or more periods, one thing to keep in mind is there may be a dollar increase in an account, but the relative percentage of the account could decrease. For example, the dollar amount of inventory could increase over the prior year, but what we could see is that inventory amount becomes a smaller percentage of assets because it depends on how all those other asset accounts change. And that's why one of the reasons why the common size analysis is important, in addition to just looking at the total dollar values on a balance sheet or income statement. Soon we're going to be looking at data, the common size income statement and balance sheet for Kellogg's and Post, the two large cereal companies. And when we're looking at two different companies within the same industry with a very similar business model, then when we see the differences, for example, how does cost of goods sold as a percentage of sales differ between the two companies that have basically the same business model? We can really highlight answers to questions such as which company is better at controlling their costs. Same thing with selling general administrative expenses. Similar business models, if one has a significantly lower selling general and administrative expenses as a percentage of sales, we can take that as being they can spend less or incur lower costs of selling and running the business and still produce the same amount of sales. That company should be more efficient with their costs and therefore more profitable. However, when we look at companies in different industries, we can expect to see very large variations, not just due to the company's ability to control costs, but the business model and the structure of the business. So for example, pharmaceutical companies in general tend to have very low cost of goods divided by sales. But supermarkets tend to have very high cost of goods over divided by sales, and the reason for that is pretty straightforward. So we can see a large difference based on business strategy. For example, Kohl's and Nordstrom might be in the same industry, but they have very different business strategies. So you should see cost of goods sold being a greater percentage of sales for Kohl's as it would be compared to Nordstrom. We would see Tesla, ideally, having much greater investments or expenditures in research and development as compared to a company like Ford. So we're going to look at several different companies and see what information we can find. What are some questions that we might want to be able to answer from looking at a common size income statement? So the big question is, where did our sales dollars go? Now, we're not really spending these sales dollars, because when we say spending, we really mean spending cash. But if you think of it as where did those sales dollars go? They go to cover our expenses, and then anything that's left over after covering those expenses remains as net income. So some of the questions, or some of the specific expenses that's important to remember that we're looking at, for every dollar of sales, how many cents, is another way to look at this, went to cover our major expenses? Cost of goods sold, selling, general, and administrative expenses. If we have this information, research and development. That's really important to a company's business strategy, but many companies are going to lump research and development into their selling, general, and administrative expenses. Remember, research and development is a type of operating expense. If it's significant and important enough, so important enough to the investor and large enough in size, it could be reported as a separate operating expense by the company, but it's up to that company to decide whether they want to report research and development expense separately from other operating expenses, or SG&A. All companies are going to report interest expense separately, so we can see even though sales are not driving interest expense, the company's financing its business with debt. That debt requires interest expense, and we're financing our assets, which then should be producing sales. So it's an indirect relationship between interest expense and sales, but it's also important. And another one that's not direct is income tax expense. We know it's not income tax expense is not driven based on sales, it's driven based on income before taxes. But one determinant, a big determinant of income before taxes, is our sales. And net income, finally, net income divided by sales, or the proportion of our sales dollars that remains as net income, tells us how profitable our sales are. Obviously, the more of our sales dollars that remains as net income, the better. Let's take a peek into what some examples are of selling, general, administrative expenses are, or otherwise known as operating expenses. We mentioned research and development. Other items, marketing, advertising, promotion expenses, salaries, rent, depreciation expense. But we have to remember that for manufacturing for companies, and that's mostly what we're going to be analyzing, any salaries, rent, depreciation, utilities, insurance, any of these operating expenses that relate primarily to producing and manufacturing our goods are going to go into cost of goods sold. So they're going to be recorded as part of inventory through manufacturing overhead. And then once those goods are sold, the expense is going to be cost of goods sold. So the salaries, rent, depreciation expense that's in the SG&A section, or the operating section, are those costs that are not related to producing inventory. These are going to be related to our corporate offices and our sales offices, but not those manufacturing plants. And another main item is accounting and legal. And why are we writing this stuff out? So that when we see SG&A as a percentage of sales, as a manager, we can kind of think about, well, what might be behind that? We might not know the specific amount of SG&A related to R&D or corporate salaries, but as a manager, which you guys will be eventually, if not very soon or already, we want to think about how do we control these costs, because that's a big component from a management perspective of doing the common size analysis. And so I have this question down here, can the proportion of sales dollars spent, and again, it's not really spent because we spend cash, we don't spend sales dollars, but maybe it's more technical to say, can the proportion of sales dollars allocated to these items, can they be reduced without lowering future sales? And obviously that's not an easy thing to do, but that's what management is driving towards. What might we see in the non-operating section of the income statement? The big one is interest expense. What else might we see? Just the more common ones. We talked about a number of these at our first class meeting. Interest revenue, income on investment securities. And these investment securities are bonds and loans made to others. So we are not borrowing, we are not the issuer of the bonds, we are the lender. And when we're lending money to other, we are issuing that note receivable. We're going to earn interest revenue. Dividend revenue on investment securities. These types of investment securities we're talking about is when we buy stocks of other companies, and then gains and losses on sales of long-term assets, investment securities, buildings, and equipment primarily, but not limited to these items. So if our sales dollars are supplemented by other revenues and gains, will this be a one-time event? That's why we care about the non-operating items as a percentage of sales. Sales is not driving these non-operating items, but how much of our sales is being supplemented by this? Obviously, it's better to have these other revenues and gains, but they're less likely to persist into the future. I'll take a few notes about the common size analysis of a balance sheet before we actually go into working these calculations. So what questions can we try to answer from a common size balance sheet? One major one is, what is the asset structure? And so we're thinking about what assets comprise our company, because these assets are used to generate future revenues. How much is in cash? Cash is important, but too much cash as a percentage of our total assets might be unproductive or inefficient. How much is tied up in receivables? How much is in inventory? How much do we have invested in plant, property, and equipment? How much is in leases? And how much is in intangible assets? Now, there's no exact right or wrong amount in each of these items, but we want to just have an idea of where is this company investing? Because those investments produce future revenues. So the left side of the balance sheet is the asset mix or asset structure, and the right side of the balance sheet is that financing mix, where we're looking at debt versus equity. Remember, debt must be repaid, and debt also results in interest expense. Equity does not need to be repaid, but remember, those stockholders need to have a return on equity. And we'll be talking more about return on equity starting next week and continuing for the few weeks after that. Within debt, current versus long-term. We talked about that on our first class as well, the importance of being able to meet those current liabilities, but of course we still have to meet those long-term as well. We might want to look at, how does the percentage of current assets compare to the percentage of current liabilities? How does the percentage of debt or maybe total liabilities compare to interest expense? And maybe even to sales. We know that interest expense is the result of having debt, and whether perhaps long-term debt and short-term debt, or maybe even looking at total liabilities to interest expense. But sometimes we don't have, sometimes we might just want to think about, how does debt compare to the percentage of the company's debt? Ideally, we're using that debt to buy our assets, using our assets to generate our revenues. So we can indirectly compare that percentage of our balance sheet that's in debt to our sales. Actually, returning back to that last slide, I think this reminds me of a nursery rhyme I used to tell my children. You borrow the money to finance the assets. You finance the assets to generate the revenues. I don't know why she swallowed a fly. I guess she'll die. I'm not exactly sure if that's right, but that's about how I used to say it to my children. Just thinking about a few of these companies here. So when we're doing the common size analysis of the balance sheet, I like to go into this thinking, what should I expect? So just take a few companies over the course of this video and the homework. We're going to look at each of these 4 companies plus others. But what would you expect to see Kellogg's, Microsoft, Tesla, Alphabet, which owns Google? What would you expect their largest investment to be? Plant, property, and equipment, maybe inventory, maybe investment securities, maybe intangible assets. Have some sort of expectation in mind before you do your analyses, and then it's a little bit more interesting when you get the answers, because you can sometimes be surprised by what you find. Let's move now to our analysis of Kellogg's and General Mills. We'll start with Kellogg's, and then we'll add General. Actually, General Mills is going to be something that you're going to work on your homework. I believe I may have put on post. So let's start by opening up the Excel file. That's called Common Size Analysis for Companies. And so, yeah, so I need to update that PowerPoint. We start with Kellogg's income statement and Kellogg's balance sheet. We have the data just from the most recent financial statement. And then we're going to end up comparing Kellogg's data to Post for the most recent periods for each of these. These are 2 companies within the same industry, very similar business models, so we can really see the differences. But before we get to those differences, let's start by how are we doing these calculations? Remember, we're going to take each item as a percentage of sales, so obviously sales is going to start as a percentage of sales. I want to, once I have this formula, I want to be able to drag it down and across, so I want to lock it here to always reference 5. And then I drag this down, so it's going to take each item here as a percentage of cell B5, and I can drag it over, my formula over, and now I'm taking C5 over locked into the cells as the denominator. And so when I drag this down, I'll have each income statement item as a percentage of sales, and I can do that for all of the 3 years. Now we have a lot of information here. Really what we're focusing on is this common size portion. And we start with cost of goods sold. How much was cost of goods sold as a percentage of sales? And you can see in our most recent year and the 2 years prior, it was 68%. Somehow we were able to lower the costs in the prior year, the fiscal year 2020. Down to 66. So we, as a manager, we might want to say, what can we do to get back there? What's changed? Or is there nothing that we can do? Is it going to remain about, is it typical for it to be about 68%? Selling general administrative expenses. I see that they were reduced from 22% in the 2 prior years to 20%. So that is very favorable for the company. They're spending less on their SG&A, a smaller portion of their sales on SG&A, and they were still able to increase their sales. So they're being more efficient. Operating profit. So what was the impact? Let me write some notes here. Operating profit. Okay, so we have 2 factors going on. When we look just at the prior year, we see 2 changes. This increase in cost of goods sold was unfavorable for the company. But the SG&A decreased. So we can see the net effect of that was operating profit as a percentage of sales decreased over the prior year, but increased over 2 years prior because of this decrease in the selling general administrative expenses. Interest expense, we can see, was consistently 2% of sales. Other income or expense. So what does this title mean? Other income, parentheses, expense. If the number is shown in parentheses, it would be a net expense. So you can think of losses on sales of plant, property, and equipment, losses on sales of investment securities that were greater than dividend revenue. So we're putting together all those other revenues, gains and losses, expenses all together and showing them net. So since these numbers are all positive, that means the company is generating other income or revenues that are greater than their other expenses and losses each year. And so we see quite a significant increase over the prior year as a percentage of sales. So this was high in 2021. Remember, the year ended January 1st, 2022, refers to the fiscal year 2021. This is just one day later than calendar year end. So it was high in 2021, and that's going to help offset the increase in cost of goods sold. And so what does that do to income before taxes? Well, when we combine our increase in the other income, the non-operating income, with the decrease in selling general administrative expenses as a percentage of sales, we're doing better than this downside decrease or decrease in our gross profit margin, increase in our cost of goods sold as a percentage of sales. So we see that it's steadily increased 2% each year, which is great. So I'm going to write steadily increased, and for the reasons that we explained up here. Income taxes went up a little bit, 1% as a percentage of sales. And then finally, when we come down to net income, we see a nice, slow, steady increase. So we've improved our efficiency of the profitability of sales. We were better able to control our costs over the period. Now let's move to Kellogg's balance sheet here. So remember, our equation is going to be each asset divided by total assets. And I want to lock in that total assets as my denominator. I'm going to put this dollar sign so that I can keep that 16 as the, even when I drag down, I still want to see divided by this cell, B16 each time. Format doesn't look very good, so I'm going to change the formatting here to show a percentage. Much better. And we had 3 years on the income statement. We only have 2 years on the balance sheet. That's because that's how the standard reporting is. I could have added another balance sheet, but this is just quite a bit simpler. And collecting all of these financial statements to do this analysis has been an extremely time-consuming task. So I tried to save time wherever I could. Let's continue now for our each liability and equity item as a percentage of total liabilities and equity, but we know assets are equal to total liabilities and equity, so I can just take a shortcut and just do B16 again. Or I could have just taken this formula and continued on. Wherever there are no values, I want to make sure this is not reported. It just looks neater. And then I'm going to drag this over for the year prior. And now I have each item as a percentage of assets, each liability and equity as a percentage of total liabilities and equity. Now I'm ready to start my analysis. So no change in cash as a percentage of total assets. We see a slight decrease in accounts receivable as a percentage of total assets. That's good as long as we're collecting our receivables faster. We see a slight increase in inventory. That's okay as long as we are expecting future sales to increase, and that's the reason why we're holding more inventory as a percentage of our total assets. Or maybe we became more efficient with our other assets, and so that's the reason if we decreased our PP&E, our inventories would increase as a percentage. So we have to keep going with our analysis before we can make any claims. No net change in our total current assets, no net change in our plant, property, and equipment. See a lot of stability here in the operating leases and goodwill. Other intangibles went down just a little bit, and other assets went up just a little bit. So overall, not a whole lot. One thing I want to point out is that I would have expected Kellogg's to have more of their assets in plant, property, and equipment. So I just want to point out this is only 20%, only 21%. I would probably have estimated, I don't know, 40 to 60% of their total assets had been in buildings and equipment. It's a manufacturing company. So that was interesting for me to see. And what is their largest asset investment? It's in goodwill. And when I went to the financial statements just to find out a little bit more about goodwill and other intangible assets, it seems this was probably generated from Kellogg's owns a lot of different brand names. If you just Google Kellogg's brand names, you'll see all of the different ones that you'd recognize. And I guess this is from buying out other companies, not so much having all of these buildings and equipment, but most of their assets are from buying other companies and spending a lot on them. Remember, when we spend more to acquire another company than the fair market value of the net assets of that company, we record goodwill. So we're expecting these brand names to help bring us future revenues. Let's go down to the liabilities section. And again, we see a lot of consistency here, just a very small increase in the portion of the current portion of long-term debt that's going to be due within the next year. Very slight increase. Accounts payable make up 14% of the company's total financing mix. Current liabilities, 29%, consistent year over year. Long-term debt decreased, which might be a good thing if we're concerned about interest expense. If I come down to see the total liabilities, I don't have a total liabilities line here, but if I come down to look at, do I see an offsetting increase in equity? And I do. So I see the company used 3% from their financing. They use 3% less out of liabilities and debt, 3% more out of equity. Where is that coming from? In equity, there's an increase in retained earnings. If we want to know more about that increase in retained earnings, where could we go? Of course, I did that. We need to do that here to look at that information because I think we have a lot here. But what we will see if you pull up Kellogg's 10K and look at their statement of changes of, actually not retained earnings, we call it statement of changes in stockholders' equity. What we'll see is that the company had a lower dividends payout. So they kept more of their income added to retained earnings without paying out as dividends. And that's what led to this increase over the prior year. So this flows down to see total equity went up at 3% as a percentage of total financing. And that about covers the common size analysis of Kellogg's balance sheet and income statement. If we want to take just the data in the most recent year, remember this would be the fiscal year 2021, and this is post fiscal year 2021, even though it's not the exact same period, it overlaps for the most part. And we can see which company was more efficient with its cost of goods sold. So when we take companies in the same industry, this really helps us point out, okay, Kellogg's is more efficient. Cost of goods sold as a percentage of sales. How about SG&A? Kellogg's had a little bit higher. As a percentage of sales. That's okay as long as this is going to bring us future revenues, as long as it's going to pay off. And so what's the net impact of this? Operating income from Kellogg's is higher because the decrease in cost of goods sold outweighed the cost of the increase in the SG&A. Post had much higher interest expense as a percentage of sales. And Post did not have any other income as a percentage of sales, or didn't have any other income, whereas Kellogg had other income as a percentage of sales of 3%, which is, of course, going to help its income before taxes and therefore its net income. So we see this very big difference. What is this attributable to? The difference between the 14% of sales remaining as income before taxes compared to Post's 5%. This is the cumulative difference of having lower cost of goods sold, lower interest expense. and higher other revenues and gains. Now, Kellogg's did have higher income tax expense, but after all expenses are included, we can still see that Kellogg has significantly higher net income as a percentage of sales. They kept more of their income after covering all expenses. When we look down the balance sheet, we see that Post is holding much more cash. Kellogg has much more in receivables. Kellogg has more in inventories. That net effect of current assets, that's just 2% higher for Kellogg as compared to Post. You see Kellogg has quite a bit more invested of its assets invested in plant, property, and equipment. We can add the operating lease to the plant, property, and equipment because we don't see any operating leases for Post. And so we can see that this amount here, 25% compared to Post's 15%. This is now it's not a better or worse. It's just telling us how is this company set up? How is it structured? We see that Post has a lot more in goodwill and Post has a lot more in intangible assets. So the question to the investor is, how is this going to help us generate revenues? What's the ideal amount? 25% of our assets in plant, property, and equipment versus 15. Intangible assets of 45% versus intangible assets of 62%. We don't know the answer to the question, but as we have future sales, we can start to go backwards and say how efficient were these long-term assets in producing sales. Now to the financing side, we're just looking at high-level information here. Current liabilities, long-term debt, operating lease liabilities, which are often considered to be long-term debt, and then other. We see Kellogg has significantly higher current liabilities. Again, not bad. We can compare Kellogg's 29% of its total financing and bills that need to be paid next year compared to their current assets. And we see that current liabilities are quite a bit higher than their current assets. But we don't see too much cause for concern. Long-term debt, we see that Post uses significantly more financing in debt than they do equity. We should see the opposite of this. We should see stockholders' equity be quite a bit higher. Actually, we don't. The reason for that is that because Kellogg is using so much of its current liabilities of financing, they have almost the same exact amount of equity, but Kellogg uses much more current liabilities and Post uses much more long-term debt. So Kellogg just needs to be able to make sure that they have enough cash available to pay that off next year. And Post needs to make sure that it's not tied to too much long-term interest expense, that it's going to be able to pay that off in the future. So we have looked at Kellogg's alone over time. We looked at Kellogg's compared to Post, two companies with a very similar business model. What if we compared Kellogg's and Post? So we've already done this analysis. What if we compare them to companies in a very different industry or different industries? Here I have the data for Microsoft and Alphabet. So starting with the income statement, cost of goods sold. So we said that Post cost of goods sold was quite a bit higher than Kellogg, but compare them to Microsoft and Alphabet. So we can see Microsoft has significantly lower cost of goods sold, which is very good for the company because that's going to flow through to their profitability of their net income as a percentage of sales. SG&A, we can see that Microsoft has the highest SG&A. So the question for us is the reduction that we're getting with cost of goods sold as a lower percentage of our sales, is that offset by having higher SG&A? Now, Microsoft and Alphabet, the company that owns Google and Nest and Fitbit, but Alphabet we know is primarily Google. Microsoft and Alphabet both report on their income statement research and development expense, sales and marketing expense, and general administrative expenses. Kellogg and Post don't. They only report their selling general administrative expenses. So these numbers here are just the breakdown of this 27%. These numbers are the breakdown of this 26%. So we can see that these two companies spend the exact same portion of their sales on research and development. We can see that Microsoft incurs a higher cost of sales and marketing as a percentage of its sales, but lower general administrative expenses compared to Google or Alphabet. We can see how Microsoft's low cost of goods sold as a percentage of sales affects its operating income, how it's significantly higher than the other companies, but particularly significantly higher than Kellogg's and Post's. We can also see how this flows down through net income. We see that Microsoft, for every dollar of sales revenue for Microsoft, 36 cents results as net income. Compare that to Post, where every dollar of sales to Post, only 3 cents remains as net income. I'm going to go down to the balance sheet and go just a little bit faster for the sake of time. You can go through each one of these and kind of think about, what does this mean? What do these changes mean? But let's highlight just some of the major differences. Microsoft and Alphabet have about a third of their assets invested in investment securities, stocks, bonds of other companies, and governmental bonds. So we would want to see these results in, ideally, other income, other gains on the income statement. We don't see a whole lot of other income and other gains on the income statement here. But that's ideally what's going to happen with that investment. We see the same amount of assets in receivables for Microsoft and Alphabet, and higher compared to Kellogg and Post. See the highest amount of plant, property, and equipment investments as a percentage of assets for Alphabet. And nobody has beat Post's 37% of assets invested in goodwill, and all the way up to 62% of their assets invested in total intangible assets. When it comes to financing, we see that Post has the most long-term debt, and Post also has the most total liabilities, followed closely by Kellogg. Unsurprisingly, Post has the lowest percentage of stockholders' equity, and we see that Alphabet is using the most equity to finance its business. For your homework, you'll be asked to use a balance sheet and income statement that I've put together for General Mills. I took it from the SEC's website and just made a few simplifications on it. You're going to use that to update these numbers to a common size income statement and a common size balance sheet for General Mills, and then answer just a few very basic questions on the homework assignment. Once you've finished your analysis of Kellogg's, Post, and General Mills for the homework, the next thing you're going to need to do for the homework is open up the file called Common Size Analysis of 6 Companies that's posted on Blackboard. And what you see here is exactly what the file is titled. Some companies that we already are familiar with, Microsoft, Alphabet, and Post Holdings. And then 3 additional companies, Costco, Kohl's, and Tesla. You have the dollar amounts for each income statement and balance sheet item for these 3 companies, Costco, Kohl's, and Tesla. But you're going to calculate the common size numbers, which should be very quick and easy. Then we're going to use the data for these 6 companies to answer questions that are listed in Blackboard. The questions aren't challenging. Something like which company has the highest cost of goods sold as a percentage of sales. It's not a difficult question, but it's just getting us to try to think about what kind of questions can we get, what kind of information can we get from doing common size analysis, and what can we learn about these companies that we're familiar with from our everyday lives. And now let's turn our attention to trend analysis. Returning back to our PowerPoint slides, trend analysis is also called horizontal analysis. Our analysis is going across, and for one company, so we're going across time, and therefore A trend analysis or horizontal analysis is useful for evaluating a series of financial statement data over a period of time. Each financial statement item is calculated as a percentage of some base year. What we do, and then just standard practice is to take that answer and multiply it by 100. So for example, sales in year 2021 in a trend analysis, we're going to take sales in 2021, the current most recent period sales, and divide it by sales of some base year. Now, what's the right base year? What are we comparing it to? Well, we just choose. For this video, I went back 6 years. I took the most recent 6 years of financial statement data. And so I use the 6 years prior to as the base year. And we're looking at each period, years 1 through 6, relative to that base year. And then standard practice is multiply it by 100. So sales in 2018 would be 2018 sales divided by that sales in that same base year. Some items that we need to keep in mind is that trends cannot be calculated or interpreted when an item has no value in the base year, obviously. So if there were no operating lease assets 6 years ago, which is quite common because the accounting rules didn't require us to record an asset related to operating leases 6 years ago, but that has since changed, we can't calculate the trend analysis there. We also can't calculate or interpret it when the base year is a negative amount. When doing the trend analysis for Microsoft for the homework, delete the formulas when you do your analysis that show divided by 0, that means the base year is 0, and Excel is saying we can't do that. Delete it. We always want to make sure we're not reporting that, not just here, you're not turning this in, you're just answering questions based off it, but when you're doing this at your job, you never want to send in a schedule that has this error message. And also delete results for any base years that have negative values, and just makes it easier to interpret the results. Trend analysis is used to answer questions such as, is the company growing its investments or is it liquidating? How does an increase in sales compare to an increase in cost of goods sold, selling general administrative, and or interest expense over time? How does an increase in inventory, receivables, PP&E, intangible assets, how do they compare to the increase in liabilities? We can also compare changes in balance sheet items to changes in income statement items. For example, how do the changes in sales correspond to the changes in receivables? How do changes in cost of goods sold compare to changes in inventory? How do changes in debt compare to the changes in interest expense? How do changes in investments compare to other income or interest revenue? How do changes in plant, property, and equipment relate to changes in depreciation expense, if we can find this information on depreciation expense? Oftentimes it is not reported separately on the income statement. We may be able to find this information in the footnotes, but we're not going to get to that level of detail in this assignment. And then how do the changes in tangible assets compare to changes in amortization expense? And again, amortization expense is not likely to be found directly on the income statement. If the analyst wants to, they can go to the footnotes and see if any information is reported there. So let's conduct a trend analysis on Tesla. We're going to go to the file in Blackboard called Tesla Trend Analysis. Here is our Excel spreadsheet, which shows the income statement information for the 6 most recent years. And then on the second tab, we have the balance sheet data for the 6 most recent years. So to do our trend analysis, I'm going to copy the headers. And I'm going to set each financial statement item as a percentage of some base year. And our base year is the earliest year here, which is the fiscal year 2016. And convention says multiply it by 100. I'm going to lock the reference to column G and drag this across. And then I'm going to drag this down. I want to eliminate any divided by 0 errors. I want to change the formatting of these numbers so that I don't see so much information here. Okay, so this is the information here that I want to be focused on. Here's my common size sorry, here is my trend analyzed income statement, our trend and income statement. So everything is being reported as a percentage of fiscal year 2016. What do we see here? We see revenues with a dramatic increase each year between 2016 and 2020-21. And I chose Tesla for a reason because it really exaggerates a lot of the changes over the recent period. If I had pulled up Post Holdings, the cereal company, we're not going to see nearly as dramatic changes. For the homework, you have you're assigned to Microsoft. I've given you the income statement and the balance sheet. You're going to do the calculations for the trend analysis, and you're going to see much more moderate changes over the 6-year period. So what can we say about revenues? Revenues increased almost eightfold over the 5 years prior. To go from 100 to 769, what does that change? Well, a numerator would be 769 minus 100 divided by 100. So it would be 669% increase in revenues. So we have a dramatic increase in revenues. Okay, now how did our other items change? Cost of goods sold, cost of revenues increased just about the same, but less. Which is great. Tesla was able to generate even more revenues than the increase in its cost of goods sold. And Tesla reports gross profit separately here, so we can see this impact of having a higher increase in revenues than we did in cost of goods sold, and we see this dramatic impact, 8.5 times. The revenues for fiscal year 2021 are 8.5 times greater than the revenues in 2016. Now, how did these change? Sorry, not revenues, gross profit. How do our operating expenses change over the period? Research and development. So while revenues went up almost eightfold, research and development expenses increased just threefold, which is great. So they didn't have to increase their R&D nearly as much as in order to generate revenues that increased such a dramatic amount. 211%, or 3 times as much. And we see about a similar change in SG&A as we see with R&D expenses. Of course, this shows a similar increase in our operating expenses. Now, this income loss from operations, we said when our base year is negative, we really can't interpret our amounts here. So we're just going to take these numbers out. Same thing with our interest expense. It's shown as a negative. So actually, since it's shown as a negative in each and every year, those negatives will cancel out. So this is okay. Interest income, we see a very large increase, but look at the dollar amounts. This is mainly due, so it's a large percentage increase, but a small dollar amount. So it's really not that important. And interest expense, we see that interest expense, look at how much it increased between 2016 and 2020. And then we see a very big drop from 2020 to 2021. So what we should see is a very big drop in the amount of debt. And if I go to the balance sheet and I look at long-term debt, which is generating that interest expense, I have my debt and finance leases, and my debt and finance leases is the number that we're looking at here, and we do see a big drop across these years. So that would make sense. Other income expense has not changed too much. Again, we can't really interpret the income loss before taxes. We know that Tesla is a relatively new company, and so it operated at a loss for quite a few years in our sample period here. We can still gather information, but just not at the subtotal level. You see that taxes went up dramatically, but if we look at the dollar amounts, we see that the base amount was very small. So even a rather small change of that small denominator base amount is going to result in a large number. So again, we would say this is be a large percentage increase, but a small dollar amount. So it's really not that meaningful. What are we taking away here? This dramatic increase in the revenues that were more pronounced than the increase in cost of goods sold, and not nearly as dramatic an increase in research and development and selling general administrative expenses, which means there was a very, very large increase in net income over the period. Now let's move to the balance sheet, and let's start with doing our trend analysis of our balance sheet items. Okay, our most recent year divided by our base year. I'm going to lock in column G so that I can drag this across. Just looking at these numbers here, I see a trend that looks very similar to my change in sales, which is not terribly surprising. Although, I mean, really with cash, anything can happen. The company can decide it wants to maintain a low cash balance. And again, format just as we did on the income statement. Make these numbers easier to read. Get rid of those decimal places. Okay, so this is what we're focused on here. And we see a large increase in cash. And I guess that could make sense if the company, as it's growing, it wants a larger dollar amount of cash. Restricted cash, they no longer have any restricted cash, presumably because it's a less risky company now that it's profitable. Accounts receivable increased quite a bit, but if you look at the dollar amounts, it's really not that much in whole dollar amounts compared to that increase in sales. So we expected an increase and perhaps a much bigger increase based on how much sales. What do accounts receivable relate to? They relate to the credit sales. I can say the same thing for inventory. So while sales went up almost eightfold, inventory went up almost threefold, or 178%. So I would say, again, just like with the receivables, not as much increase in the inventory as there was an increase in sales over the period. We see a dramatic increase in the prepaid expenses and other current assets, but if you look at the dollar amount, it's not that meaningful. We have, again, a large increase, but small dollar amount, so not very meaningful. Plant, property, and equipment only doubled, which isn't much considering the increase that we saw in sales. So we can say that they're using their plant, property, and equipment quite efficiently to generate sales. We see that intangible assets actually decreased over the period, but we see the dollar amount is not really that much. Let's come down here. Let's look at total current assets. So while sales were able to increase 670%, our assets only increased by about 170%. Let's come down to the liabilities. Let's jump down to our total current liabilities and see that total current liabilities increased 238%. So we have an increase, but not nearly as dramatic as the increase in sales. Not that debt is going, or short-term debt is going to, current liabilities are going to increase exactly as sales do, but we know that they're related. In finance leases, so we took a quick look at this earlier. We saw the dramatic changes in interest expense over the period. And what do we see? We see debt and finance leases, or long-term interest-bearing debt, was increasing, and then it began to decrease over this period. So the company in recent times is relying much less heavily on debt. These other items are relatively small dollar amounts, so the changes aren't quite as meaningful. So compared to an increase in sales of 669%, we see only an 83% increase in our liabilities. We could call that a relatively small increase. And how about equity? Let's jump down to total equity, total stockholders' equity. We see that went up quite a bit. But again, we see the dollar amounts are not so great. Most of this is coming from common stock plus the paid in common stock plus additional paid in capital. These accounts here, again, we see very small dollar amounts. This relates to par. This is the amount received above par. And so I can infer that the company must have issued some shares of stock in this period to have such a large increase in their additional paid in capital. So they are paying down their debt, issuing new shares of stock. Is that better or worse? We're going to talk about the trade-offs between debt and equity as the semester continues. And for your homework, you're going to be doing a similar analysis that we've done here to using Microsoft's balance sheet and income statement for the most recent 6-year period, and then answering questions in Blackboard. If you find you're having trouble as you're working on the homework assignment, please reach out to me. Otherwise, we have just one more week of material before we meet again for our next class. And remember, we have that quiz the day before our next class meeting.